Welcome back to another Senior Learning Institute's educational moment, where older adults and their loved ones turn for honest and straightforward information. In just a few minutes, you'll enjoy bite-sized, easily digestible nuggets of knowledge, empowering you to make the right decision the first time. So without further ado, here's our founder, certified senior advisor, seniors real estate specialist, nationally syndicated podcaster and speaker, the advocate you can trust, Mr. Ted Gottlieb.
The thought of having to pay your own or a loved one's long-term care needs can be overwhelming. For others, it's not even on the radar. It's when we start to feel our age, have a health event, or become caregivers, does the light bulb turn on. At that point, our options will likely be limited. If the idea of minimizing your out-of-pocket exposure and having options if the time comes appeals to you, you've come to the right place. Mr. Bill Comfort is one of the most respected names in long-term care planning. If I were to list Bill's credentials and experience, we'd be here a while. So I'm simply going to welcome you, Bill, and thank you for sharing your expertise with us.
Well, you're welcome for that, Ted, and thanks for having me on. This is it's a nice catch up for us, and the programs you've been putting together have been terrific so far. I'm glad to be part of it.
Well, that's great. I appreciate it as well. And you and I have done some work in the past in regard to some podcasts that you've done. So I appreciate, and I'm sharing the love back at you. So, I really feel as though you're at the top of your game, and I really want to share that experience, your experience, with everybody else. So let me start with a question, Bill. When is the best time or age to start planning for long-term care?
Yeah, and that's kind of a loaded question, and maybe purposely so. The best age to start planning for long-term care is now, is as soon as possible. And there's sort of two parts to that, I think. And let's be clear, or let me be clear from the top. Planning for care and buying long-term care insurance as a way to help pay for professional care are two different. They're interrelated, but they're two different steps or stages of the process. So really, at any age, you really ought to begin to think about it. What kind of care would I want for myself, for my spouse? What role would I want my spouse, my partner, my kids to play, or more importantly, not play if I needed care? Just that broad thinking everyone should be thinking about. Now, practically, most people begin to engage in this planning process and looking at the insurance as a funding vehicle for at least part of the cost by age 50. By age 50 or 55, if you're in that range or getting close to it, that's the time to really get serious. Your health's still good, prices are still good. The reason we don't see a lot of people doing things before that is because there's competing interests. Now, if you're 66, 67, and you haven't dealt with this yet, let's get started today. I think once you get to 70 and older, there's still options for advanced planning, but they become expensive, harder to qualify for, but it's at least worth a conversation, but it might take you down some different roads other than, the kind of the primary solution people think of, which is an insurance product. But the bigger picture is, what kind of care do you want? Where would you want it? And who's going to help be part of that? That's the broad planning question. And then looking toward insurance potentially.
Gotcha. Yeah, it's funny you mentioned competing interests, which is an interesting term that you have. When you think about it, I mean, we're schooled to save for retirement. We're putting money together for 529 plans, and we've got all these different competing interests, and something's got to give. And there was a point when I sold long-term care insurance for a major company for a minute, and I sold a few policies. Sold one to myself and my wife, and we got to a point where the market changed and income wasn't coming in, and we had those competing interests, and we let that policy go. Now, we ultimately went back and bought a different type of policy,
right?
But at a certain point, something had to give, and unfortunately, that was it. And we were lucky enough not to have a life incident that didn't impact us or didn't prevent us from applying again, but that happens frequently, and that's something that I think some people don't think about.
So yeah, just, I mean, a couple thoughts on that broad subject of when do you get started. You know, a lot of boomers had kids or even started a second family later in life. So maybe you've got kids, teenagers still at home when you're 50, 52, 55, and they're still facing college. It's hard to look at yet another new expense like long-term care insurance, but that doesn't mean you shouldn't get started. You know, you could lay a very affordable base plan down first and then come back to that, add on that onto that later. I think that's a mistake people make, is they think they have to wait till they're ready to do the whole program up front, where maybe staging it is a better idea. Again, it's a planning process, and that's the approach I take in my engagement with clients, not just, hey, do you want to buy long-term care insurance, yes or no, and how to do it, but what really makes sense from a broader standpoint.
Right. This is part of a long-term care plan, in my opinion, and
Right.
it's something that needs to be treated that way. So I think we're in agreement that long-term care insurance seems to be something that everybody should own, but not everybody does, other than what you've already mentioned, and maybe what I'll term denial more than anything else. What are some of the other reasons that you hear that people don't actually move forward?
Yeah, first of all, well, on a couple of things, just not moving forward on what I call a grown-up or an adult conversation about the subject of planning and preparing for care. Whether you buy insurance or not, that's a funding choice. And then the idea of buying or not buying long-term care insurance, I think the reason people take action or don't take action, either way, are very similar. First is a natural inclination not to want to confront the subject. Who does? Who wants to think about getting old and becoming frail to the point that you need help, bathing, dressing, or, having a cognitive type of an issue like Alzheimer's or dementia? None of us want to have to confront that part of our lives. It's the same reason, Ted, that people put off doing what they know is basic estate planning. The basic wills and trusts and healthcare documents that everyone has to have. I mean, look at this COVID thing, ventilators, no ventilators. You got to have those documents in place if something happens, but nobody wants to think about it and go sit down with the attorney and get it done. But you have to do it. It's just one of the things you have to put in place. So part of it is just not wanting to confront that reality. Secondly, I think there's a natural belief it's not going to happen to me. I don't want to think about it happening to me, and so I'm gonna put it off or ignore it. And one of the things I like to help people think about is, yep, you can't go through life fearing the worst, but you have to plan for reasonable inevitabilities. And here's the important connection: everyone, particularly 50 plus, is planning for retirement. Maybe you're not saving enough yet. Maybe you don't have enough yet, but everybody's thinking about it. Why? Because we all expect reasonably to live a long life. And having enough money so you don't run out of money, just paying the basic bills in retirement, is critical. So my question that weaves the two together is this: if it's reasonable to plan your retirement, your investments, and your savings to pay for your basic lifestyle needs, because you could live to 85, 90, if not longer, isn't it reasonable you could need care for a few years along the way?
Yeah, and I hear what you're saying, and people can relate to that. I think most people can. Who can relate to it even more is the children of folks who have been dealing with a
Right.
parent's illness or a parent's death when the estate planning was not taken care of
Right.
at the time and the cost, in a variety of different matters in regard to dealing with those estates and everything else that comes along with it. Those are the folks who come running after
Right.
they're all settled to take care of their own needs, because they don't want that to be their legacy for their children.
But here's the thing. So only about 10% of Americans, particularly over age 40 or 45, own some kind of long-term care insurance. And based on health and demographics and finances, It's estimated that at least 40% of Americans could or should own the insurance, could afford it, could buy it, could qualify for it. So why the big disconnect? And it's because people aren't planning ahead. So folks who've been through it with their parents or grandparents, yeah, as you said, they come running to buy the insurance because they've lived it out. They've had to roll up their sleeves, put their lives aside, and they don't want to do that to their kids. So one of the things that has to start happening is you and I, other financial professionals, have to begin to introduce this subject with folks who are not yet ready to buy insurance necessarily for care, but who need to begin putting the plans and the costs potentially into their other plans, particularly their retirement and investment planning. And I think we'll see that grow when people realize there's really not a better way to do it. I think the other biggest thing that I get, right or wrong, crunch the numbers or not, is people say, I can probably self-insure. I can probably self-fund, self-pay for this. At the end of the day, that's just another way of saying I don't think it's going to happen to me, because most people don't have enough money to both pay out their lifestyle needs as long as they and their spouse live and pay for care at the same time. It doesn't work. Unless you're super ultra rich, it doesn't work. But again, this is part of the process, is helping people analyze where they are individually in a way that they can think about and work on without it having to be this direct sales engagement, which of course, a lot of people are afraid, oh my God, Bill, the insurance guy, I don't want to talk to him. It's just not how I approach the subject.
Yeah, and I think once you start to see the costs that are involved, and you and I live with it every day, but we see, assisted living at, let's just say on the low side, $3,500 to $4,000 a month, to the high side over $10,000, $12,000, $15,000 a month, or in-home care at $22, $23 or more an hour. It starts to add up really, really quickly. So we need to do our part to just kind of share what the potentials are. And let's just make the assumption that you and I have just done a really good job and have got people thinking about this a little bit more seriously. What do those folks need to look for and look out for when they're considering long-term care insurance?
Yeah, great question. So I think the biggest mistake that I see people make when they're coming to this subject with a little education or even some advanced education is they think they have to buy insurance for the total worst case amount of the cost of care possible. Like you mentioned, 9, 10, 11,000 a month in high-end assisted living, or worst case, a nursing home. And people look at that, and if you quote the insurance for that amount, nobody can afford that insurance. So the problem is care starts at home. 80% of care is given at home. 80% of the caregivers are family caregivers, not because they wanted to, but because there was no other plan in place. So if you think about it, a policy that would deliver $3,000, $4,000, $5,000 a month, oh my word, that's going to keep somebody at home without wiping out their spouse or their family, lifestyle or health, in caregivers, by just giving them enough of a break. It's going to pay nearly all of very good assisted living. And if you do end up in a nursing home, it's a significant contribution to the cost. But what we found claim-wise, Ted, this is really interesting. People with long-term care insurance go into nursing homes at a dramatically lower ratio than people who don't, because they have the means to pay for the other alternatives and stay out. And those who do go tend to go for shortened periods of time where it's not, the devastating cost that's there. So the first biggest mistake is trying to buy too much coverage, and that right sizing is important. I think the second thing in today's market is you have to be very careful what you're being offered. There's all kinds of policies, and we could talk about this in another episode here. There's these new, what are called hybrid insurance plans that marry life insurance with long-term care, or an annuity with long-term care benefits. They're great tools, but they tend to be much more expensive than what we call traditional long-term care insurance. And there are a lot of advisors out there who will only offer one or the other, or only one type of a hybrid plan where you got to put 50 or 100,000 in up front. I mean, that might be a good solution, but I'm seeing way too many people being shown one option that somebody, some agent, some advisor says, this is the best thing to do, this is what you should do, without really looking at the marketplace. You know, my practice, I represent a dozen different companies and all of the different types of policies. And my job's to help the client find the right fit. And there's a lot of misinformation about all of these different types of policies out there. So you really need a specialist that can make sure you're getting the best kind of coverage for yourself. I think those are kind of the two biggest things at this point. Make sure it's right-sized and therefore affordable, and that you're buying it in a way that really fits the rest of your finances most appropriately.
Gotcha. And I'm glad you mentioned that hybrid policy, because I was actually going to ask you that question, because sometimes people say, you know, I don't want to buy a long-term care insurance policy if that's all that it's for, because if I don't need it, I've wasted my money. But just give me 2 minutes on the regular life insurance policy that can be converted into long-term care if you need it. Just the basics. How does that work?
Sure. And there's two types that's out there. There's straight life insurance with a rider that lets you accelerate your death benefit. So that's truly double purpose, but you never get any more long-term care than your death benefit. That's not the best option for planning for care if that's your primary goal. There's some other types of hybrids or combos where there's a basic death benefit, and you use that up over the first 2 years, but then the policy extends the long-term care for another 3 years, 4 years, 5 years, one option even for an unlimited lifetime period. So those plans where you've got basic life insurance, and the concept here is if you never need care, the death benefit is paid to your heirs. You know, it at least returns your premium back to your heirs. They're very appealing because of that reason. In my analysis, for most people, you actually would be better keeping the extra premium on an annual basis for the same long-term care benefits. You're going to pay 2 or 3 times more for a life insurance solution. And if you're not getting quoted apples to apples on the long-term care benefit. Or you're having to dump in $60,000 to $100,000 lump sum, and maybe you'd be better off keeping that in your own pocket and paying as you go. Bottom line, there's not a right or wrong here. It's what's best for each client. And that's the approach that I take, is to find what makes the most sense to each client. And back to your question, folks say, well, what if I pay for 30 years into this long-term care only and then I never use it? Well, thank goodness. But recognize you paid a lot less than if you paid premiums to also have life insurance coming back. There's nothing free here. You're paying for that life insurance.
Right.
So it's an important part of the analysis. These policies become very popular, and they're really ideal for many people, but they're not perfect for everyone, I guess is the message.
Got it. All right. Well, thank you for that. Let me ask you one last question, because we are trying to keep these brief, but as you know, as you mentioned, we can go on forever talking about this topic. But what are the options for those of us who decide that we want to get long-term care insurance, but we can no longer get the coverage because of a health event that we had? Because we all need to be underwritten. It has to go through a process to get approved. So let's just say we can't get approved because we had a health event. What are our options?
Yeah. So let me stage that out. there is a wide variety of underwriting criteria among the insurance companies. So if one company says you're not insurable, particularly if it doesn't make sense to you, particularly if you're still independent and nothing is dramatically in decline, it's again why you should work with a specialist who's a broker. I mean, I've had clients declined by company A, and I've had two other companies that are willing to consider that health history. So you need to, take a look at the marketplace with some help. So that's one stage. If you're truly not insurable for the traditional coverage or the life insurance based coverage, some of the annuity plans, because you have to put in a lump sum to fund the annuity first for, say, the first 2 or 3 years, they will then give you another 2 or 3 years of extended long-term care benefits with much less underwriting, because the insurance company doesn't have any risk for the first couple years. You're basically taking your own money back on a tax advantage basis from the annuity. So there's some things like that that can be looked at. If you're not insurable for that, that's where you really have to focus with a good estate planning and, or could be the same person, an elder law attorney who can help make sure that what you're doing today financially is at least ready to transition into helping you pay or prepare for something like Medicaid, which is our state, safety net system to pay for care for folks who don't have money. But there are some things that you can do in advance if you don't have other options.
Right. So this is a team sport. It's
Right. Oh,
getting
yeah.
together with your financial advisor, your insurance folks, your elder law attorney, and really putting a plan together. And that's something that I really try to drive home with all the folks that I'm working with. Before we even start talking about selling the house, I want to make sure that there's a plan in place. I mean, I might be walking in a situation where I sell a house and I'm doing a lot of damage because of the planning that's already taken place. So there's a lot of communication that needs to be had. Bill,
I think, and just one more thing that ties back to, closer to your business. For people who are uninsurable, and it's being used much more broadly than just course money of last resort, but reverse mortgages could be a great way to pay for care if you don't have any other options either, and that ties back into good real estate advice and planning as well, which is your wheelhouse.
yeah, thank you. And then we've actually had Dennis Cooper on talking about reverse mortgages and that being an option to pay for care, and also
Right.
an option to purchase another property. So there's a lot of things. Again, it's a team sport. You really need to get together with a good group of people who can help you through the process. And this planning process typically is free of charge. So that's one of the things that we do at the Institute here. Bill, I want to thank you so much for your insight. And again, we can keep going all day. This is just the tip of the iceberg. But if somebody wants to get in touch with you and learn a little bit more, what's the best way for them to do that?
Yeah, the easiest thing for me to share is my website. It's my last name, Comfort, just like it sounds, comfortltc.com. My phone number's on the website. There's a contact form. You can request a quote, and there's a lot of information to add to this information we've been talking about today. So comfortltc.com, and I'd look forward to hearing from anybody.
Yeah, for sure. And then this is also available on audio podcasts as well. And there are going to be some folks who don't have access to the internet. So in regard to going to websites. So phone number, I have an 888 number. Is that still good?
Sure. That's the best number to give. And yeah, if somebody can look that up on your site, that'd be great, Ted.
Yeah, and I'll give it out just in case anybody wants it handy. It's 888-507-3588. So that's 888-507-3588. And again, this is just a tip of the iceberg as it relates to long-term care planning. So please check out Bill's website, give him a call, because he can really, really help. I want to thank you all for listening to this Senior Learning Institute educational moment. At the Institute, we strive to provide the straightforward and unbiased information you need to make smart decisions the first time. So whether you're looking for tips to stay safe in your home, to sell your home in any condition, if you're looking for estate and financial planning advice, tips on caregiving, tips on finding senior living communities, estate sales, decluttering, you name it, we've got you covered. either through our online resources or through our free nationwide referral network. To learn more, please visit us at seniorlearninginstitute.com. Until next time, I'm Ted Gottlieb, Certified Senior Advisor, Seniors Real Estate Specialist, and founder of the Senior Learning Institute.